Hello and welcome back to another episode of Unlocking Your Financial Future. I'm Ben Schrock, and joining me is our Chief Investment Officer, Keith Lockwood. Keith, welcome back to the show. Wish it was under different circumstances, but I pulled you away from the desk as the markets were all over the place. Figured we'd spend 10, 15 minutes chatting a little bit about what's going on and kind of get your thoughts as to we head into this Q3 and into the election and the rest of the year, and just see kind of what your thoughts are, where we are, and kind of go from there. So, we'll kind of start out with what really happened leading us up to today. As I speak, it's August 5th, about 3 o'clock. Markets are still going, but last week we had pretty much an okay week so far, and then Jerome Powell spoke on Wednesday. Again, his message has been pretty clear, pretty consistent. Rate cuts are not off the table, but they're not cutting them for this month. And then jobs reports came out and on Thursday or Friday, or unemployment reports a little bit higher than expected. And then the markets kind of reacted. So I guess kind of that was the leading events up to it. Is that really the case behind the scenes? What's really going on, or are we missing something there?
Yes and no. Okay. I guess there is that underlying, is the economy slowing significantly? We're headed to a recession, blah, blah, blah.
Hard landing, all that.
It's all the guys that have been saying we're headed to a recession when the Dow is at 30,000. Now it's at 38,000. Yeah. And we're, eventually, if you say it enough, it'll come true, right? So, but the more and more of those guys come out, the better it is, right? Contrarian. Mm-hmm. So the economy's in good shape, good position. What you're seeing today, actually overnight, it really wasn't today. If you actually look at where we were pre-market to where we are right now, it's been a huge comeback, a huge comeback, even though we're still down 2% as we speak. But so what happened overnight is basically what they call the carry trade. So it's a sophisticated, method of investing that hedge funds and, PE guys and, the people with a lot of money, were basically using other currencies that had low interest rates. So basically the Swiss franc and even more the Japanese yen. So they're basically...
Which was like, the yen was what, zero still?
Yeah, very low. The interest rates in Japan were extremely low and weak versus the dollar, right? So you can get more bang for your buck, especially using leverage and margin. If you want to use margin in US dollars, your percentage is much higher because of where interest rates are. You use it in, the Japanese yen, you're getting a lot more money. And what they were doing is turning around and using that leverage and buying basically the large cap tech,
right?
The Mag 7, however you want to call it, NASDAQ basically. Yeah. Well, last week, the equivalent of the Fed in Japan, and I'm simplifying all this, unexpectedly raised rates. So now it's like covering a short, right? So they got to go in and cover their leverage, because
quickly too,
right? Because now, the dollar's becoming stronger, blah, blah, blah. Like you got to cover quickly. You're going to lose money, a lot of money.
Yeah.
So they have to cover their currency trade. And in turn, what that means is they got to sell the large cap tech, Mag 7, NASDAQ. They've already made money on that. So they're basically covering their currency trade or leverage, right? So anything that didn't have leverage is not getting killed,
right?
It's just the liquidity. There's a liquidity issue, and that's kind of what you saw. And if you look at what the yen did overnight and what the NASDAQ did overnight, they basically mirrored each other.
Very similar.
Yeah. So it's that carry trade that's caused all the issues. And everything was overnight. We're still down a good amount, but compared to where we were, the NASDAQ was down 1,200 points at one point.
Yeah.
And I think we're down 500. That's if you say we were intraday move of 700 points, it'd be, right?
That's
it's hugely
crazy.
talked about. But but the economy's still in great shape. Unemployment ticked up, but
it wasn't that big of a miss, right?
They're still creating jobs. It was the jobs report. So we're still creating jobs. But you got to remember with those reports, there's it's like the polls, right?
Yeah.
Here's where everybody stands, but there's a plus minus of 5% because of, statistics and how statistics work. Well, that's the same thing with the jobs report. Mm-hmm. And they had said leading up to it, a lot of economists, like this one wasn't going to be accurate because of what was going on kind of in the world. Mm-hmm. And, with some of the economic events and some of the events as far as the weather events and that sort of thing where, that's people just self-reporting.
Right.
That they weren't going to get around to self-reporting. So if you actually look within the margin of error, it could have been actually a great jobs report.
Yeah.
And everybody's yelling at the Fed, not cutting rates. Well, I've been saying this for, 6 months now. When the Fed cuts rates, it's not going to be because it's a good thing.
Right.
It's going to be because the economy is not doing well. And, you go and you look at earnings, right? So we're almost through quarterly earnings, and it's been a 78%, positive. So above estimates.
Yeah.
Normally that's 75 to 76%. So we're above that. And then if you look at estimates, moving forward, what they're predicting, usually if you take the average, it's a 15% growth rate, right? We're at 16% growth rate. So, it's the companies aren't reporting bad, aren't estimating bad. And this is just, you have corrections in bull markets. It happens. And this is just one of those.
This is kind of one of the perfect storms as we, head into typically a weak quarter, the weakest quarter of the year, leading up to the election, right? There's a lot of hot button topic items that you can kind of hit on. Fed's not cutting rates, all that stuff. But really behind the scenes, this was kind of a hopefully short term sell off that had to be sold to cover.
There's a reason for the big sell off, right? It's seasonally weak. August and September, the worst months.
Yeah.
Every year.
Right.
You throw into that, an election. You also have, Iran allegedly is now going to go after Israel. So, there's a lot of that going on, as geopolitical stuff going on as well. So, but we're still, we're still at that point where over 5,100, I think, is the resistance level. I think we're at 5,200. You get below there, I think 4,800 is where you're at. You're probably going to bounce back and forth from where we are now in that 5,000, 5,100 level.
For the next trading zone.
For the next couple of months. You may drop down to 4,800 like in September.
Yeah.
But it's still all short term. That's 2 months.
And that's really not a ton more on the downside. We're talking maybe 5%?
5 to 8%.
Yeah. So again, not that we want that to happen or we like the downside, but what it does is it creates opportunities to rebalance portfolios, take advantage of companies that their price has fallen just because of these events, and take advantage of the time that we're in.
That, and if you look at the underlying economy, the underlying market is still strong. Yeah. It's not, don't see a recession coming, maybe something soft, but nothing, there's not a lot of overinvestment, in the world right now. I think the financial markets, the banking world is not, in bad shape. So,
well, it's just interesting that it's like anything nowadays, right? The media drives everything out of proportion and immediately the finger gets pointed at Powell, and here comes the hard landing, and boom, into a recession because of what, 2 bad days in the market.
Right. And Berkshire Hathaway reported over the weekend, and they sold half their Apple and half their Bank of America. So that's causing everybody to, be scared, but no one knows the reasoning behind that.
And when they sold it, because they reported on the end of Q2 doesn't mean they sold it in May.
Right. And he got in to Apple so many years ago. His return is outrageous. Who knows maybe he's getting out of a huge return on both of those, because he's got huge return to put in cash to invest in something else.
Rebalance a little bit, right? Right. It's like any investor.
Right. As I heard today, maybe he's, God forbid, he's not long for this earth, and everything's going to charity.
Sure.
Right. So maybe he's just putting a bunch of money in cash so the charities get cash instead of, equities, which then they have to go around and sell, so, no one knows why it's happening or why he did it. There's all the speculation, and then, I heard what I hear today. I'm going to start using this line because it's basically how our world reacts today when it comes to everything. It usually is, ready, aim, fire.
Yeah.
Like, great, slow down, but it's fire, aim, ready, right? That's the world we live in, and how we react, and everything's emotional, whether it's a headline or a Twitter story or it's not Twitter anymore, X or, we see a 30-minute clip of a 5-minute, 10-minute speech, and all of a sudden our biases kick in, and here we are. So
now what, I guess, just to kind of extend this, do we expect some of this to trickle over into the next week or so, with people kind of following suit, just the general herd mentality, people exiting the market just because, or is this kind of something that should normalize relatively quickly?
No, I think you'll get back to normalize. So the VIX hit 65 this morning, which is the third highest ever. It didn't even hit that point
during COVID,
So, and if you look at the VIX futures markets going out like 3 months, basically where it hit, where the futures markets are traditionally signals it was a low.
Okay.
So, so you have that, and you have interest rates coming down, which, they're going to come down in September, whether it's a quarter of a point or 50 basis points. It's going to come down. You still have $6 trillion sitting in money market accounts.
Yeah.
Which people love it because they're getting 4.5% in a money market account. Interest rates come down, they're not getting that anymore.
Yeah.
So where's that money going to go? That's $6 trillion is a lot of money.
Yeah. And at what point at the Fed funds rate do people make an exit out of the money market accounts, and where do they put the money?
It's coming at some point,
right?
Because rates are coming down. And people, again, short-term memory, right? Used to getting 5.
Yeah.
Even though when you get 3.5, still a good number, but that's not going to happen. So I think it's going to normalize. I think you're still going to get the pullbacks, and you're going to have, V-shaped recoveries. So,
and as you said earlier, these are normal, right? Oftentimes we forget when we're in kind of this euphoric state that corrections do happen, pullbacks happen within bull markets.
Yeah, all the time.
Yeah.
You can look back at any time in history, and it always happens.
Yeah.
I still think we're in that extended bull market.
Sure.
Just with some of the advancements we have in technology, and where we're going there, and we're not overextended. You got opportunities now. You got companies where PEs were maybe a little extended, but Microsoft is down, with their PE. Nvidia's down with their PE. Amazon's down with their PE. All these that were maybe extended now aren't extended as much. So, and they all still have quality earnings that aren't going away.
Yeah.
It's not the .com era where you had companies that were selling for prices that were outrageous and they had zero earnings. That's not what we're in right now. So I still see opportunity, and I still think the market's going to end at, found around 5,600 when it comes to the end of the year.
A little rally at the end of the year post-election.
Right.
Leading up to it, though, volatility is here to stay, right, for the short term. I mean, probably till election time, right?
And even a little after, depending on what,
So buckle up for a little bit of a ride, but all things considered, it's not something that you see, as you said earlier, not a crash landing recession type situation on the horizon. Pretty just some volatility and normal volatility at that, given it being an election year and everything else going on in the world.
Yes, but I mean, especially with seasonality as well. Like, this is the worst 2 months every year.
Yep.
So that's kind of what we're heading into. Just to expect it. So
cool. Well, Keith, I appreciate the time. Now, what was the name of the carry trade? Carry trade. So go ahead and Google that and look that up and let us know your thoughts on that. But Keith, appreciate the time. Definitely interesting to peek inside your head a little bit and see what's going on in there and what your thoughts are with the current conditions we are in. So appreciate you taking some time. And if you have any questions for us, you can reach us at 330-473-1060, or you can look us up online, www.baschrock-fg.com. Thanks, Keith.